Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Mathew. One of the easiest, most uncomplicated ways to invest in the equity markets in India is through index funds. They allow you to invest in the constituents of an index. And the most popular index funds replicate the benchmark Nifty 50. That's where most of the money, in fact, gravitates to in the passive strategy space. It's uncomplicated because when you put money in these funds, you're simply investing in the 50 stocks that form the Nifty 50 in the proportion of their weightage. What that means is that if you put 100 rupees, for example, into a Nifty 50 index fund, you're effectively putting 13.5 rupees in HDFC Bank and about 10 rupees in Reliance Industries as things stand right now, and the rest, of course, according to the weightage. But consider this. There are also passive strategies that use the index as a base. Passive strategies with a twist. These are called smart beta strategies, and some of them have quite comfortably beaten the benchmark over the past several years. We're going to be talking about one of these, the equal weight strategy. I spoke with the Joint Chief Executive Officer of SBI Mutual Fund and about the scheme, and in fact, they've got a new fund offer that is offering the equal weight index with regard to the Nifty 50, and I began by asking how these schemes work.
This is a smart beta strategy, right? In any index fund, you generally, what do? You put as per the weightage. You don't have to do anything. You just put, if I take 100 rupees, I will put 100 rupees in the same weightage as the market cap is there in any of the funds. So what happens if today I get 100 rupees, then 13, 14 rupees will go into the HDFC Bank or Reliance Industries, and top 3-4 stocks will get me around 40 to 50%. So in an era when only these four stocks are doing very well, then the index will do well. But in generally, the top 50 companies of the country are so well governed, so much good businesses are happening. So getting the benefit of that to the fullest extent. So the smart beta strategy is there, where we will be putting all stocks in the top 50 stocks will put in the equal weight. Every stock will get around 2%. It could be 1 or 2% here or there, like rather than 2%, it could be 1.97, 1.98 or 2.01, 2.02. But more or less, it will be in all the 50 stocks in the same strategy. When the overall businesses are doing well, overall all the sectors are doing well, this gives a very, very good representation to participate in the growth story of the country. That's what our strategy is.
Interesting, because I was looking at your presentation as well, and as you point out, the top stocks account for a very large chunk of the Nifty 50, and as of the end of December, or the last weightages that we looked at, as you pointed out, yes, HDFC Bank around 13.5% on the Nifty 50, and the top 10 stocks are 57% of the Nifty 50. But in this case, the top 10 stocks on the equal weight index would only be about 20%. So there's a very dramatic shift. Could you talk about instances in the past where there has been outperformance, underperformance based on this difference in strategy?
If you look at the last 15 to 20 years, in majority of the years, the equal weight index has outperformed the market. There are some exceptions, like in 2019, we know only 4 or 5 stocks were taking the index high. It was HDFC Bank, HDFC itself, because at that point these were not two merged entities. Third was Reliance Industries. These 3, 4, 5 stocks were taking the index high. That was an exceptional year where Nifty 50 gave much better return than the equal weight. But otherwise, in the normal years, in last year or the year before that, more or less, then every year, the equal weight index has given better return than the normal Nifty 50 return in the equal weight. In the normal weight. So that is something which gives us a lot of confidence because we personally feel in the fund house that with the increase in the market capitalization and with the maturity of the market, the big companies should get the proper representation, which is not there as of now. In fact, if you look at US, it is S&P 500. And in our country, it is Nifty 50 or BSE 30 for now so many years. There's a structural change. Beyond this, Nifty 50, even we are thinking of once we are done with that, maybe sometime later we can come with the NSE 100 also, or BSE 100 as well. Smart beta equal 1% in each. So the point is that this is the fund which gives due representation in a cycle where all the businesses are doing well.
That's an interesting perspective, and it also changes. It's not just the stock representation, because ultimately we're talking about a benchmark for the market which has sectoral representation as well, and because of this equal weight you have far greater representation of sectors as well, right?
Yes, that's right.
Okay, so the other aspect to talk about is the response or the interest in investing in passive strategies. In your experience, considering that you actually cater to a wide gamut of investors, not just those in the top 30 odd cities, what is the kind of interest that you have seen in passive strategies in the recent past, and what is the kind of interest that you are getting with this scheme as well?
See, Alex, I am very confident that we'll get very good response in this, because this is very simple to explain. And it's not complicated, very simple, because simplicity sells. When we are talking about the going less than breadth of the country in the smaller towns, etc., if you get into a very complicated structure, it becomes very difficult to explain to a layman what we are talking about. This story is so simple that if you want to participate in India's growth story, there's no other way but only to participate in the equity market. And through equity market, with the larger representation of getting into the larger companies first, that is a general phenomena all across the globe. Whenever somebody enters into a particular area first to get into index, first to get into the below the line. And we have also seen last year, I think more than required, money has gone into small and mid cap. So this year, in any case, we feel that 2024 belongs to large cap. And within large caps, the simple strategies like this should give a very good response to the investor, and that below.
Okay.
So that's a
fair point. And also from the perspective of when you are talking to people and when distributors are also selling this, from the fund house perspective, are you pitching this as something to look at in tandem with other strategies? In that, should this work as a partnership with, say, a traditional index fund strategy, so that you have the equal weight index plus you have the Nifty 50?
Now, if you ask me personally, Alex, we always have been telling the people who have been traditionally putting money in Nifty 50, we have always been advising them, guiding them that they should get into either Nifty Next 50 or because what happens, there's a lot of demand supply thing. A lot of FIA, FPA money coming into the country. And the first thing when somebody enters into any market, as I said, for a layman, it's true for even FIA, they first get into the index. And index, what is happening, all the structural money which is coming into the market, a majority of that is going into the top 4-5 stocks, which is making these stocks very costly. And we have seen in the recent prices last 3-4 days only, how a particular stock's beating has brought down the indexes so much. And that light, if we get into this kind of simple strategy of equal weight, that makes much more sense. And yes, we have been telling these regulators also. Regulators, I see, I am not talking about SEBI. I'm talking about the government and other places where they are generally approving only Nifty or only BSE 30. So we are telling them to get into some more strategies, some smart beta strategies. So if you don't want to take risk in the beyond 100 or beyond 50, within these 50 stocks or these 30 stocks, we should have a smart beta strategy. And smart beta strategy, all of them big stocks have done very well.
My last question. Sorry to cut you, sir. Finish your point, sir.
No. What I'm saying is this education will take it to the masses. And what we think in SBI mutual fund, unless until you bring in the simple products which are explainable to the investors, it should not be a push product. It should not be a distributor-centric product or a mutual fund-centric product. This should be something which is good for the investor who want to participate in the growth journey of the country. Should come in a very, very simple and very responsible. And this is the responsible investing which we feel.
Fair point. My last question, since you've spoken about smart beta, and incidentally, I've been looking at some of these strategies. If you're talking about value, if you're talking about momentum, if you're talking about certain other quality, for example, by and large, these strategies seem to be consistently beating the traditional benchmark. But we don't have a lot of products available, and I don't think enough conversation has happened. As a fund house, are you contemplating in the near term widening your portfolio of smart beta offerings?
Definitely, we are contemplating that. We already have some of the strategies, and we will come up. We have one minimum variance fund also. But see, as we talked earlier, we have to take it to the length and breadth of the country. We have to start with simple product. This is one of the simplest products where anybody will understand what we are talking about. Next, as I told you, we can go to the bigger basket of 100 or 50 stocks in PSC, something like that. But the idea is that start with simplicity. Once people evolve, they understand, then go to the very fancy products. Now, all these products which are there, like you talk about momentum or value, the target audience is very small to understand. And we don't, these passive products cannot be pushed like active funds, right?
Yes.
All across, you can't push it. So, start with the simple products, take it to the next level. And as you are aware, we are getting into a developing economy. And the developed economies had started like this only. Today, they have thousands of products and the passive. We are following the footsteps. And more we are globalizing. We will see more attraction towards this. And while saying so, I would like to put a disclaimer. There's a whole lot of alpha generation capability available in the country. The active funds will also remain very, very relevant for all the time.
That's an important.
We have a huge audience across the country. We are a country of 140 billion. That's where it becomes very heavy that we should have all kinds of strategies and come out with the fund which can attract the layman, the bottom of the pyramid or the mid size of the pyramid are attracted towards these funds.
All right, so that was the fund house's perspective. Remember, SBI MF has an NO4 that is open, but there are also other equal weight strategies that are available in the market right now. The question is, how does it fit into your specific portfolio? And how do you use this in tandem with the other investments that you make in the mutual fund space? To talk about this more, we've got a couple of advisors joining in, but we have to slip into a very quick break first. Do stay tuned. Welcome back. You're watching the Mutual Fund Show, and we're speaking about the equal weight strategy of passive investing. We're joined now by Amit Kukreja, the founder of AmitKukreja.com, and Tarun Birani, who is the founder and chief executive officer of TBNG Capital Advisors. Thank you so much to the both of you for joining in. I think this is an important time to be speaking about the equal weight strategy, right? Gentlemen, it's a day when HDFC Bank is down a further 3%, and this is on the back of several cuts that have taken place already. So if I had just at the start of last week invested in a Nifty 50 index fund as well as a Nifty 50 equal weight fund, I would be down less on the equal weight fund than on the Nifty 50. That's a simple mathematics of it. The question is that the most obvious benefit of investing in such funds? I'll start with you, Amit.
See, Alex, first of all, good to be back with you again. It completely depends on what you want to have as your investment philosophy. If you do not like volatility, if you do not like too much of an upside or downside swing, then you are more aligned with value-based or value investing strategy. So when you have a value investing strategy, that's when the equal weight index composition will come out to be beneficial for you. But if you're okay with the momentum investment strategy, then you will see the swings more on the upside or the downside. And if you're okay to stomach that movement on the upside or downside, then it's your call, then that makes you comfortable. But some people like more diversification, some people like more steady returns because they believe in power of compounding, and they also believe that less of a standard deviation will give them a good sleep and a peace of mind. When that's up to them. So you decide what is the nature of volatility that you can stomach, and accordingly you can choose your investing strategy. That's what I think about this.
Okay, fair. Let's spell this out a little further, and we'll talk about the drawbacks as well. But Tarun, anything to add in terms of what you think are the key benefits of investing in an equal weight strategy?
Right. Hi, Alex, and hi, Amit. First of all, Alex, I think you started with the HDFC examples to start with, and I feel in hindsight we all are heroes, right? I think we just feel that we could have made this, we could have made that, but I would give another example also where one stock has moved 200% in 1 year, and because of market capitalization strategy, the index has benefited largely because of that, right? So I think these things will keep happening in market. So I don't think we should go too much in detail. As rightly mentioned by Amit, that what is the suitability of the client, what is the risk profile of the client, how much risk the client can stomach. These need to be the most important consideration before selecting any fund or any schemes for your portfolio. Talking about equal weight portfolio, according to me, the most important thing it brings to the table is diversification. Unlike a market cap oriented strategy, which is purely focused on market cap, a equal weighted strategy will have larger diversification. So benefit of diversification will be there. Another very large benefit equal weighted strategy gives is rebalancing on a timely basis. So since they have to maintain an equal weighted at all the time, so the rebalancing will be much better compared to any other strategy. So any investor who want allocation to be managed in a systematic manner and rebalanced on a timely basis, I think the equal weighted strategy is a very good strategy. Again, the potential of outperformance and underperformance, like you mentioned one example, that definitely comes with equal weighted strategies. And I think from a simplicity and transparency point of view, it's a great strategy according to me. But at the same time, can I spell out some disadvantages also of this strategy?
Yeah, go ahead, because I was coming to that anyway.
Yeah. So one big disadvantage which I feel is higher cost and turnover ratio of this strategy compared to any other strategy which we look at on smart beta. So since they have to maintain equal weighted at all the time, so it will involve higher cost because they need to maintain that. Apart from that, volatility, according to me, they will exhibit higher volatility due to inclusion of smaller companies in the portfolio. So apart from the top companies, equal weighted companies will have on the lesser market cap companies also in the portfolio. So it will have larger volatility because of this. Again, due to market efficiency issues can also comes in because of equal weighted thing. And again, because some less efficient companies may also be part of your portfolio. And there could be some liquidity concern also compared to, let's say, a market cap oriented, the top companies will always have better
Right.
liquidity compared to these companies.
Got it. So you've laid out both the advantages as well as the drawbacks. But when it comes to actually including this in your strategy, in your portfolio, Amit, should this be a part of a passive strategy? So often you talk about going up to 50% even as a passive strategy, particularly to form the core of your portfolio when you're talking about a large cap orientation, right? This is something that some people pitch as adding to that passive strategy. So it's not the core of your portfolio, it's a kicker or in addition to your original core strategy. Is that how to approach it?
It's up to the client. I personally recommend the passive index funds, which are mimicking the index in the market cap orientation strategy. Equal weight is yet to prove its merit in terms of whether it has consistently beaten the fund manager's style of managing the investments. We recognize the fact that whenever you have come out of a bear market, your equal weight index have delivered better performance than the momentum-based index or a market cap-oriented index. However, if you look at the data and the stats for last 20 years over a 5-year rolling period return or a 10-year rolling period return or a 3-year rolling period return, you would notice that it is not consistently outperforming the market cap orientation. So I believe that if you're making 50% as a core portfolio of a large cap fund, then you can go up to 5 to 10% of equal weighted index. The rest can be market cap. That's my personal belief, and others can have a different view. Until we get some statistically confirming data that it outperforms the market cap orientation index fund, then it's fine. Plus, also remember, Alex, our indices are market cap. Our indices are not equal weight. So it becomes easy for us to benchmark the performance of my portfolio with respect to the index. And as long as my benchmark is identical, it's easy for me to kind of keep track of the portfolio performance.
Quick 30-second view on this one, Tarun. Do you want to add to that? So Amit is talking about a 5 to 10% of that large cap orientation or that passive orientation. What do you think?
So I strongly feel, Alex, that there is a core portfolio and a satellite portfolio. And core portfolio is a portfolio which basically is aligned to your larger strategic goals, right? But when you look at tactical portfolio, you may look at strategy which can perform well in a certain market environment. So there are strategies like momentum strategies. There are strategies like low volatility strategies. There are strategies which are like a strategy like this, what we are talking, equal weight strategy. So I feel one need to do more research around various market cycles and which strategy has worked well in which market environment. So higher interest rate environment where you are expecting high beta or lower beta kind of things to do well. Right. I think a low volatility index can do better.
Right.
So I would purely take it like a core and satellite mix of the client portfolio. And in the satellite portion, one can actually look at it if the market conditions are right.
Tactical allocation. Understood. Thank you so much, Amit, as well as Tarun, for joining in and giving us that perspective. So the crux essentially is that this is a strategy that can potentially beat the benchmark, but you should ideally use this as a tactical allocation or a satellite allocation in your overall portfolio. If you've got questions for us, you should send them to us on any one of our social media platforms, and we will in fact very soon have a WhatsApp number to share with you as well. There's lots lined up over the course of the day. Do stay tuned. This is NDTV Profit.